So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at Option Alpha, and welcome back to The Daily Call. Today we are going to be talking about what I refer to, I guess, as the dentist adage for traders, which is one trade a day keeps the black swans away. So we've all heard that, I guess, a kid's tale or kid's phrase that you would say to your kids, like one apple a day keeps the dentist away. But I think in trading, it is truly at least one trade a day on average that keeps black swans away. And so I think this was timely because, as you know, we've just been going through a lot of turbulent market movements. We're starting to see markets really pick up in the speed and velocity in which things are moving in both directions. We have days now where we're, making 100-point moves within the same hour on the Dow and the S&P, and it's kind of crazy. What I always tell people, and I've told people for a long time, is that what we need to do as traders is realize that market direction becomes more and more meaningless, meaning it's not as important the more often and the more frequent you trade. It's just really as simple as that. So to use this as an extreme example on both ends, let's say that I gave you the opportunity just to make one single trade in one single index or stock, but you had to hold on to that position no matter what happened for the next 5 years. So you couldn't adjust it, you couldn't get out of it, you couldn't reverse the trade. It was one and done. So now, of course, that's a total extreme example, but it proves the point of what I'm trying to tell you, and that is that one entry that you have then becomes everything. It is the most important factor, is picking the right time to get into a security, whether it's the bottom or the top, however you want to trade it. You've only got one shot. And so what people do often in just regular stock trading and investing is they do this. They basically decide to invest, and then they invest everything at one time, or a big chunk of it at one time, or a couple times during the year. And then yes, timing becomes super important. So it's no wonder that people try to look for timing mechanisms, or they try to read articles about how to time and how to trade the markets, because their entries become super important. Now, on the further end of the extreme spectrum, you have high frequency quant funds and high frequency hedge funds that are trading thousands of times during the day and are just scalping little profits all over the place. Now, we can't do that as regular retail traders, right? We don't have that capacity yet. But the reality is that they end up neutral pretty much every single day. They're getting into and out of positions all the time. So no matter where the market goes, they're just following the market. They have so many entries and so much frequency that market direction becomes meaningless to them. Now, of course, they could get hit on one move or a different move in different products, but ultimately it smooths out. Ultimately, the noise dies down and the volatility in the account dies down, and you have much more stable growth long term. So I'm not saying that you can't have swings in your account, because we have swings in our account for sure. But what I'm saying is that it becomes less and less of an impact the more frequently you trade. And that's why we talk about laddering. That's why we talk about trade frequency as being a huge important determinant to success, because it starts to solidify the probabilities and solidify your numbers. But that to me is what I think keeps black swans away. So if you can trade during a black swan event, which I think that what we went through in early February could be considered like a mini black swan event. Nobody saw that coming. I mean, we were talking about that coming, and we had, risk-defined positions on. So we were well positioned for that type of a move to happen. But even during that event, you still have to trade on the way down. And I think that that's a huge part of being successful, is just keeping that trade frequency up and keeping your position size small so that no one big, collapse or position ruins you. And if you feel like you can't sleep at night because of your positions, then they're probably too big. And that's what I've said oftentimes. So hopefully this helps out. As always, if you guys have any comments or questions, let me know. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.